Savji Chatterjee, recording a weekly session of Chartsarefun. This is for the week of May 11th, recording this in the evening of May 17th. Today we will talk about the Chinese Internet shares. There was a coverage by Carter Braxtonworth. He's the chart master, as they call him on CNBC. This was our blog, chartsarefun.substack.com. We published this blog yesterday, Saturday, and we do publish daily blogs. If you subscribe to this channel, we'll send you these blogs through email. Our YouTube site is also Chartsarefun. We do publish weekly videos here. We hugely appreciate you subscribing to the channel, and then also if you could hit the like button if you like the content, we really appreciate that. So, talking about Chinese internet stocks, the leader, talk about the largest component in the internet ETF that they have called KWEB, is Alibaba. They had earnings. In fact, there were three key earnings this week, one from Alibaba, then from JD.com, and also Tencent, three big leaders in the internet sector in China. So looking at the chart of Alibaba, in this case, it's a daily chart, we can see a potential ascending triangle pattern. In this case, the horizontal resistance line is at 146. We can see higher lows at 117 in April, 128, 130. And then on Wednesday, the 13th, when we got earnings, we had a very nice bullish move. This is called an engulfing candle, opening at the lows, covered multiple days of trading range and closed at its highs with very strong volume. However, bears would call this a failed breakout because it did not manage to break above that key resistance line at 146. It failed right below its 200-day moving average at 149. And for the next couple of days, it came back down to the rising trend line of that ascending triangle. So it's a key test this week. We have to see if this breaks down. That would be a bearish pattern. If it doesn't, holds this and then manages to break out, that breakout from a 117 to a 146 measures closer towards a 175.8 or 176. That's the breakout that we're going to watch for. And if that breakout does come, we would expect the overall Internet ETF KWEB to also do very well. The KWEB chart, which is the Crane Shares, China Internet ETF, also has a key resistance line near 30.73, 30.74 that it tested on the 13th with strong volume, failed right at that resistance, rising lows, but the lows are not that far apart, 27.6, 27.9, and the low on Friday was 28.17. So the lows are rising, though at a small slope. The resistance line is 30.7. If it does manage to break out of this ascending triangle, that ascending triangle measured breakout comes towards 33.86, not too far from its 200-day moving average at 34.13. So that's potentially where we think this could pan out. Now, there is positive divergence. As the ascending triangle is formed, we can see higher lows in RSI. We can also see higher lows in MACD. Those two are positive signs. Looking at the bear's perspective, they would call this as a bear flag happening, because if you look at the descending triangle breakdown on the weekly chart of KWEB, from that 40.87, the peak that we saw around October, early October 2025, it broke below 33.75. That's the bottom of the or support line that it broke below. So 40.87, 33.75, you're talking about $7.12. Subtract $7.12 from 33.75, you get $26.63. That's not too far from the 26th level that it has tested in earlier part of 2025 into February and then into in the April timeframe. So there is a possibility. Now, if you look at when that last bottom formed, capitulation volume, a volume spike happened. This is a weekly chart. That particular week in early April, a capitulation volume happened when the bottom formed. Similar kind of capitulation volume can be seen here, telling us that we might not be too far from a key bottom and then a reversal. So we'll have to see this particular candle on the weekly, while KWEB made an attempt on strong volume, but then pulled back and closed at the lows of the week. This particular candle is a bearish reversal candle, and the bears would effectively say that this would break below 27.63, which is a possibility. A $1 move from 27.63 to 26.63 cannot be ruled out if you look at this descending triangle. So this again will be a key week to see, is Alibaba going to be able to break out from its ascending triangle pattern and move towards 176? Is KWEB going to be able to break out above the $30.74, move towards closer to 34? Now, out of China this week, the key travel of President Trump and his key CEOs into China came news that US decided to let NVIDIA take out the restriction of selling their H200 chips. They're not going to be able to sell their latest Blackwell chips, but at least on their H series chips, the H200, they've lifted it for them to be able to sell to the top 10 companies. Alibaba is one of them, JD, Baidu, and a few others. Now, NVIDIA broke out of a key cup and handle pattern. This is its daily chart. We can see that 212, 164 is the low end of that cup, hit 216, pulled back to 194 to form a handle, then broke out. That cup and handle breakout, you can notice that as that breakout came in, PPO percentage, move that it has had above price performance percentage move that it has had has climbed to a higher high. So that breakout from 164 to 216, we're talking about roughly $52. At 52 to 216.8, that takes us closer towards 269. We hit 236. This particular, on Thursday, because of the optimism of them being able to sell their chips. In fact, the CEO of NVIDIA, Jensen Huang, has talked about 50 billion of revenue opportunities once the sales restrictions is moved out of China. So from there, that optimism did wane out on Friday when we got the options expiration related pullback. If earnings is key, the earnings of NVIDIA is this Wednesday. If NVIDIA does surprise the market, continues to show strong momentum, not just in their current quarter's revenue, which is fairly well baked in. We know that there is 720 billion of capex spending. A lot of it will come into NVIDIA to the GPUs coming out of the hyperscalers. If that is all a strong forecast for the next quarter and for the year, they tend to typically go quarter at a time. We could expect maybe the target of NVIDIA measured to 269 could pan out this week, which could be bullish for the overall market because this by far is the strongest weight, the biggest stock, 5.5 trillion in market cap, extremely a strong weight in the market. Now, if you look at the accumulation distribution line of NVIDIA, that has been climbing since that late March low. So that's climbing, climbing higher highs, which is bullish. However, the key weakness in NVIDIA stock is its relative to its industry, the semiconductor industry. NVIDIA, we can see it peaked the relative line in early August, and it is successively coming into lower highs, lower lows since then. So that's a bearish sign, though. So if NVIDIA does reach that target, it could be a huge opportunity for smart money to exit, start diversifying out of NVIDIA. Maybe some of their money moves into the China AI. We got to see that. But potentially, this is relative of NVIDIA to its semiconductor industry. This ratio is a weakness, signaling lower lows. So that's something for us to be watching. And semiconductors, on the contrary, when this has been going off, NVIDIA relative to semiconductors, look what the semiconductors did relative to S&P 500. The industry has been red hot. We all know that, right? This has been a tremendously climbing industry from levels here at the end of March. We see how much it climbed from a relative, from 4.2 in the ratio, climbed up to 5.4. That's the huge relative performance of semiconductors. While semiconductors has been beating the S&P hands down, NVIDIA is not able to beat its industry. It's coming down. So that's a red flag on NVIDIA from a long-term perspective, something for us to be very careful about. A key news, a key technical breakout on 10-year yield happened on Friday. We have previously cautioned about it. We've said potentially this could be an inverse head and shoulder with higher yields, means bond market selling off. happened last Friday. You can see this 44.93, 44.84. That's the neckline. It's about 4.48, 4.49. You see the left shoulder at 42.05, which is 4.2%. A nice double bottom kind of ahead, 3.94, 3.95 is where the double bottom formed. Then the right shoulder to 42.26, which is 4.22. And we got this gap with that breakout. The reason of that breakout is market saw the inflation news last week. CPI and PPI. PPI in particular was over 6%. Market is nervous about that, and market, as a result, the bond market is sending a signal that they think higher inflation would cause higher rates in the coming future. We know that there's been a transition from Chair Powell retiring on Friday. Chair Kevin Warsh is going to be sworn in this week. This is a way for the Treasury market to send a signal to Kevin Warsh to be careful about any dovish stances that he may have. He is an inflation hawk. People have known him for that from his past tenure at the Fed. This is sending a signal that there could be higher rates coming. Now, if you look at that inverse head and shoulder move from this 39.4 to a 44.8, take that depth of that of the head and then add it to up there, this is a 5.02% is where the 10-year could climb. And we closed near 4.59% or 4.6%. So 4.6 to 5.22, another 40 basis points of climb is potentially in the cards with respect to the 10-year yield. Now, key thing to do, though, watch out is in this process of 10-year yield, part of what's causing this inflation is definitely oil prices. And one part which you'd say the bulls might like is the fact, not the bulls on the oil market, but bulls on the stock market may like the fact that oil prices might be sending a signal of topping out. We know that this is very much related to the geopolitical environment, but in here, you can see that 94 to 125, that's a handle breakout. So 94 to 125 is $31. Add that to 125, 156. We haven't met that target yet. We have moved to higher highs, 124, 143, 151. But as these higher highs are forming, RSI is forming lower highs. Till the very recent RSI at 61, lot lower than the previous peaks in RSI. So this, in some ways, is sending us a topping signal in the oil price ETF USO. And this could effectively send us potentially a possibility that maybe oil prices may see another spike, and that could be a top. From there, oil prices could come down. That could, of course, be good for inflation. It could help arrest some of the Treasury yield climb, which is currently extremely fearful about higher inflation. But that is the signal that could be sending a contrary view that oil prices might be coming up to a peak. Now, an impact of higher yields or higher long-term rates is directly felt on the housing sector. If you look at the housing sector ETF XHP, this is sending us a topping pattern. A topping pattern in the sense that when it topped from climbing from 83 to 110 to 124.5, higher highs in price, lower highs in RSI. That's how classic negative divergence-based topping pattern. It pulled back sharply from 124 to 83. It came back, tried to reclaim that high, failed at a lower high from 124.5. It failed at a lower high at 122.76. And look at that 6% move. This is a weekly chart last week in the home builders ETF. This is threatening to break down. If this is threatening to break down below 83 from a 124, that's $41 subtracted from 83. You're talking about it could take us down to 42, which would be a lot lower, back towards the 2022 levels from where this could come down to. Something for us to be careful about. Hoping that that may not be the case. We're hoping that this key support at the 200 period moving average at 91 rests this decline. And so this could be a higher low from 83, 91, and then a resumption of the pattern higher. That could be very encouraging for the home builders. But right now, this is looking like a bearish pattern, 6% downside on Friday. If this further declines, breaks below 83, could be a lot lower levels. Now, another area, the small caps, is very correlated to higher treasury yields. Smaller companies need capital to raise. They need lower rates. Higher long-term rates is not good for their stocks, for their companies. And we can see that the small cap ETF IWM, Russell 2000 ETF, closed with a 2.3% downside. This is kind of a bearish looking candle, open at the highs near 287 and close at the lows near 277, threatening to break below the previous week's candle, coming to lower lows. Now there is negative divergence here. Higher highs in price, 271 to 287. Look, RSI was not able to confirm that breakout with a higher high. RSI stayed flat from what it was at 271. MACD is at a lower high, negative divergence right here. So potentially, if the yields continue to climb, there is a good chance that we could see small caps take a hit and come get some downside in small caps in the days and the weeks ahead. So just to quickly wrap it up, we're talking about perhaps the internet stocks in China are setting up for a good buy. Alibaba in particular, if it's able to break out from that key resistance line at 146, can go to 176. KWEB, their ETF, if it breaks above 30.7, goes towards 34 to test its 200-day moving average. Nice positive divergence as this ascending triangle is happening. Its weekly chart, however, shows there might be some more downside, perhaps to the key support level at 26. So 26.63 is the measured target from this descending triangle breakdown on its weekly chart. If it does form, though, we could expect, because the capitulation volume, that would be a key low and then a reversal, and we could maybe see a move up to 36 from 26. A $10 move would shape up in the days and weeks ahead. NVDA has got key earnings coming out. If they wow earnings and also any positive news on the China front, which right now, after the visit last week, there's announced that the 10 key companies they would be able to sell to the H200 chips. With any momentum on earnings, this could go up to a cup and handle target near 269. It's at tested a high at 236, came back and closed near 225. So another $40, $43 or so from where it closed on Friday, if it is able to achieve that. However, the warning sign in here is its relative performance. AD did climb since the late March low of NVIDIA from 164 to 236. AD has been climbing, which is bullish, but its relative performance to its industry, to the semiconductors, is weakening. It's significantly come down from its August peak. Lower highs, lower lows is what NVIDIA is showing relative to its industry, the semiconductors. And while the semiconductors outperforming the S&P 500 from late March lows, the NVIDIA, however, is underperforming, which is a red flag to the stock, not a good long-term hold. 10-year yields broke out of a key inverse head and shoulder pattern. That breakout measures to 5.02%. We closed near 4.6%. So another 40 basis points or so additional climb for the 10-year yield. That said, the oil prices are showing, this is the Oil ETF USO, showing topping signs, and maybe a last spike could be what we're setting up for. From there, maybe a pullback is possible in the oil, which could help with the inflation, could help maybe with the treasury yield climbs. But housing sector, XHB, is directly correlated to the higher treasury yields. We can see 6% downside on last week. This, if it breaks down below 83, could be very bearish, could all go all the way down to 41. Hoping that that's not the case. There wasn't as much strong volume on that breakdown in the last 3 weeks. So maybe it holds its rising 200 period moving average at 91 at a higher low and then starts moving higher again is what our hope is. Small caps reversed last week, a reversal bearish candle last week, could have some downside, would come back at the minimum, test its breakout level at 270, would even come back towards the 244 is where its 50 period moving averages before it starts its next climb. So near term negative divergence, higher high in price 271 to 287, lower high in RSI, MACD, lower high RSI is at a flat level from the 2 peaks that we saw in price. So maybe there is some downside in small caps in the days and weeks ahead. Good luck investing. We'll talk to you next week. Thank you for listening, and please do hit the like button on the video.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.